Here's the uncomfortable truth nobody on crypto Twitter wants to print. If the stock market really crashes in 2026, Bitcoin is not your hedge, it is the exit liquidity. Welcome back to AI Coin Daily. Today we are stress testing a 2026 stock market crash scenario and asking the only question that matters for your portfolio. Does the BTC and ETH correlation with the S&P 500 finally break, or does crypto bleed harder than equities again? Let us start with the setup. Going into 2026, the 90-day rolling correlation between Bitcoin and the SPX has been hovering between zero point 0.4 and zero point 0.7 for most of the post-ETF era. That is not a hedge. That is a high beta tech stock with a ticker that starts with a dollar sign. Ethereum is even worse, often trading like a leveraged Nasdaq future during risk-off days. So when analysts warn about a 25 to 40% equity drawdown driven by sticky inflation, a credit event in private markets, or an AI capex hangover, crypto is not sitting in a separate room, it is sitting in the front row. Here is the crash scenario I am watching. Phase 1. Equities roll over slowly, Bitcoin holds, and everyone screams, decoupling. We have seen this movie. It lasts about 2 weeks. Phase 2. Volatility spikes, the VIX pushes above 35, dollar liquidity tightens, and leveraged crypto positions get liquidated first because they are the easiest to margin call at 3 in the morning. Phase 3. This is where the correlation actually breaks, but not in the way bulls want. Bitcoin drops less in percentage terms than the worst altcoins, while the long tail of altcoins gets absolutely vaporized. Think 70 to 90% drawdowns on low float tokens. The correlation breaks downward for alts, not upward for BTC. What survives? Historically, it is assets with real cash flows, real users, and real fee generation. That is a very short list. Bitcoin as digital collateral, Ethereum if staking yields hold, and a handful of infrastructure tokens with actual revenue. Meme coins, narrative rotations, and unlock-heavy alts are the first to go. The signal I want you watching is stablecoin market cap. If USDT and USDC supply contracts for 3 consecutive weeks while equities are still near highs, that is your early warning that crypto liquidity is leaving before Wall Street even notices. Last cycle, this metric flipped weeks before the real flush. So here's your homework. Pull up a chart of total stablecoin supply versus the SPX and watch for divergence. If you want me to break down which specific altcoins have the cleanest balance sheets to survive a 2026 drawdown, comment the word survive below, and I will make that video next.